Hello everyone, welcome back to Banking and Finance with Chitrak. Today, we're going to continue with our IIBF KYC and AML certification series. We will discuss the first chapter of the KYC module, KYC Policy and Customer Acceptance Policy. This is a very important chapter, not only from the exams perspective, but also for day-to-day banking needs. So, let's begin. Now, what is the objective of this chapter? Basically, we will learn about the evolution or history of KYC practices, what is the need of this KYC and what does a KYC policy contains. We will also learn about customer acceptance policy, which is an element of KYC. So, in the earlier days, banks used to take introductions before accepting any person as a customer. Basically, introduction was a guarantee from any reputed person in the locality or from a person who is already a customer of the bank. Having an introduction became a standard practice for banker-customer relationship. If there was no introduction available, restrictions like no check facility was there. This was the due diligence at that time. Then, international agencies recommended customer due diligence to counter money laundering. It was usually used when giving credit to a customer, but now it was to be applied to all customers to reduce the fraud, laundering, and terrorist finance related risks. In 1988, the Vienna Convention took place and the Financial Action Task Force or FATF was formed. Then in 1990, the FATF recommended customer due diligence as the core anti-money laundering measure. Again in 2001, the Basel Committee on Banking Supervision or BCBS issued detailed guidelines on customer due diligence for banks. This process was to protect both bank and customer and to have a safe banking operations. It was also done to build trust and confidence for clients. Now, what's the need for this KYC policy? Well, banks have a lot of obligation under the Prevention of Money Laundering Act. So, it's important to have an internal policy to implement the KYC and AML rules. RBI issued a master direction in 2016 and banks were advised to form a KYC policy using that guideline. RBI also directed banks to approve the KYC policy by the board of directors. So, after the KYC policy is approved, it is important to review it periodically as countermeasures of anti-money laundering and combating the financing of terrorists is updated continuously by international agencies. So, banks need to know these changes and review the KYC policy at least annually by updating it to the latest. Also, the PMLA and PML rules, that is the Prevention of Money Laundering Act and Prevention of Money Laundering rules, were also updated annually. So basically what happened is the board first approved a KYC policy, then the annual revision of the policy was done. After that, if any regulatory updates was there, the board again changed their KYC policy according to that. After that, the audit was done following the reports. Now, let's discuss the key elements of KYC policy. What are the elements? Those are customer acceptance policy, customer identification procedure, risk management, and monitoring of transactions. So, what are the contents of this policy? Well, it must have all the legal and regulatory requirements related to these four elements we just discussed. Each bank must have a policy unique to them. Like cooperative bank in a single city will have a simpler policy than a bank having cross-border transactions. Also, banks doing parabanking activities must include requirements from relevant regulators like SEBI for mutual fund and IRDA for insurance. Now, Ensuring the compliance of this policy is a responsibility of the organization. It should clearly state the roles and responsibilities of all the functionaries, including the board and the senior management. The key aspects are given here, that is, the senior management should be defined for the KYC policy or KYC compliance, allocating of responsibility for implementing the policies and procedures, independent evaluation of compliance functions including legal and regulatory requirements, verification of KYC AML policies and procedures by concurrent and internal audit, quarterly compliance reports to the audit committee. Also, make sure that no decision making functions for determining the KYC compliance should be outsourced. So we can tell that the main function or responsibility of the board is to approve policy and oversee the compliance. The responsibility of the senior management is to implement these procedures, and the internal audit is to verify the KYC and AML processes. Process manuals for the KYC policy should be in detailed. These manuals should clearly outline the actions of different levels for every product. Let's discuss the first element of KYC policy, that is the Customer Acceptance Policy or CAP. CAP is the foundation of KYC policy. It should have a clear customer acceptance parameter to reduce the money laundering, terrorist financing and fraud related risks. Under the Rule 9 of subsection 14 of the Prevention of Money Laundering rules, banks are prohibited to open anonymous accounts in fictitious names, and accounts on behalf of individuals whose identity is undisclosed or unverifiable. The RBI also has some guidelines for this cap. Firstly, it also prohibits opening of accounts for Benami or anonymous names. Appropriate customer due diligence or CDD is a must for any transactions or account based relationship. KYC is to be collected and updated periodically. Banks must apply CDD procedures at the unique customer identification level, that is just before even opening account. CDD process is also to be followed for joint account holders. Clear explanation of when a customer can act on behalf of another person must be given. Also, banks must not open account of individuals or entity belonging to the RBI's sanction list or any other negative lists like the Financial Intelligence Unit Alert List, criminal list of law enforcement authorities like CBI or ED, ECGC caution list, or any sanction list from various countries. Then, online verification of PAN must be done. Digital signature must be verified according to the IT Act. Also, banks must specify the documents required from customers according to the due diligence and customer risk level. Remember, no accounts should be made for anonymous or fiction names, unverifiable identities, and entities which has sanctions, also from UAPA. The risk categorization of any person are low, medium, or high. Example, the salaried employees or people having small deposits generally fall into the low risk category and basic customer due diligence is required for them. But any politically exposed persons or businesses having cross-border transactions fall into the high level of risks, and enhanced CCD and monitoring is to be done for them. Senior approval may be required for customers having high risk. Also, it must be noted that the policy should not be overly restrictive to deny banking facilities to general public, especially for the financially and socially disadvantaged people. So, this is the end for the first chapter of the KYC module. The MCQs related to these are coming very soon. Subscribe this channel and like this video if it has helped you, and do share it with your colleagues who are also preparing for the KYC AML exam. Thank you. All the best.